always nice to present at this particular conference. I've been presenting, I think, since 2018, when it used to be in person down in Santa Clara, and the quality of attendees was always very high. Um, and yeah, a lot of good interactions. So today I'll talk about AI versus physics for portfolio optimization. And yeah, before starting, I mean, there's a dedication. This talk is dedicated to my late grandmother, Mrs. Revant Nayar, because of whom I learned everything about life and markets, and who I lost just today. So that going ahead with the dedication, I will start with the talk itself. Now, we have basically three general options when we want to optimize our portfolios. Okay. In finance and quant finance, it's well known that all models are wrong, but some are useful. So we want to see which are more useful than others. So, well, what are the options for portfolio optimization? You have traditional Markowitz, which is kind of wrong. I mean, it has a lot of these assumptions that you don't have fat tails, you have IID, you don't have time dependence, but it's kind of useful. It gives you some weights that still make some sense. They give you slightly higher Sharpe ratios than just doing it randomly. So, okay, wrong and useful. I'll argue generative AI or neural networks in this field are not even wrong and useless because they are not wrong. What do I mean by not even wrong? Not even wrong means that they're essentially not falsifiable. You can come up with you can tweak the hyperparameters of a neural net to always produce good backtests, good backtest sharps that don't generalize out of sample. So, that's why it's not so useful. And physics-based approaches, I will argue in this talk, they're still wrong because nobody has the correct theory of everything of markets. Markets are complex systems, but they're a bit less wrong than either of the other two approaches, and therefore slightly more useful than something like Markowitz. Okay, so well, how would you do AI in portfolio optimization? You would maybe use a bunch of machine learning techniques, neural networks, LLMs for volatility or covariance matrix prediction. Um, what are the pros of using AI? Like, I'm not saying there's no pros. The one pro is it can account for nonlinearity that, let's say, other approaches can't, which are more traditional in nature, like Black Litterman or Markowitz. But then the cons are overfitting, lack of interpretability, and inability to account for regime shifts, tails, or time dependence. So because it's this black box, you can't essentially know which of the layers account for the fatness of tails or regime shifts, and therefore it's very hard to build in these financial facts which into these networks or LLMs. Um, well, physics inspired tools. Uh, what do we mean by physics inspired tools? We mean we use universal tools and models from physics and dynamical systems, like multifractal models for volatility prediction, using tools like multi-scale analysis and thermodynamics. This is what will be the main feature of my talk. But the pro of this model is that it has rigorous foundations. Models are interpretable, and there's no overfitting, and it accounts for regime shifts, tails, and time dependence, as we will see. Well, AI attempts at portfolio optimization have had mixed results, mostly poor, except for overfitted results. People try lots and lots of hyperparameters, loss functions, number of layers, etc., and then they have decent results. Um, but other studies also show that these models. There's a reason that allocators and policymakers do not trust AI, even after all this hype. Most of them are still using Markowitz, actually, which was invented in the 1960s because of the black box nature and the lack of interpretability of the results. When you bet money on something, you want to know what's really going on behind the hood. So AI attempts have mostly kind of failed because of these overfitting issues, black box issues, and essentially being not even wrong. And perhaps this is related to the fact that 95% of AI-based hedge funds have shut down in I think now the last 14 years or so. Since 10, but I think it's yeah, around 14. Um, so let's look at a comparison, like just a generic comparison of different approaches, you know, and how they account for or fail to account for different weaknesses, these models. So you see that, there's very few approaches that don't have some weakness or the other, like while AIML, yeah, I mean, it can account for nonlinearity, but then it can't account for non-stationarity or fat tails or any of the other stuff. So, there's pros and cons, but physics-based approaches usually uh, have uh, none of the usual weaknesses of overfitting, being black box, not being able to account for regime shifts, fat tails, or assuming some kind of linearity. So let's motivate these approaches and talk a bit about what are these physics-based scaling law-based approaches. Okay, so there's a big motivation for using scaling laws in finance. Scaling laws are very well known in physics. They form the bedrock of theory of turbulence and quantum field theory, for instance. But in finance, they've also been motivated by Mandelbrot, who noticed that cotton prices have this kind of self-similarity. So when you zoom in and zoom out of cotton prices with certain factors, you see that the statistical properties of the time series remain invariant. And we also know that RG flows often end in self-similar fixed points. So it's a non-Markov inversion of the central limit theorem. It says, okay, when you zoom in and zoom out, certain price processes generated by SDs or PDs, you get these self-similar regimes where now the properties of the time series are invariant under scaling. There's also motivations from rough volatility. A lot of people have noticed in quant finance, I mean, especially last five to 10 years, it's become very popular to use rough volatility models where empirically they motivated the fact that your volatility scales with your time scale as delta t to the power h, where h is generally less than half. So volatility, they say, is generally rougher than predicted by classical models, where h is equal to half. And this kind of means that um, any model that assumes h equal half will be wrong sometimes at most time scales. It'll only be right at the time scale you started off with. Let's say delta t equal 1, which is usually 1 day. Uh, so yeah, this is, again, a kind of a well-known empirical fact that traditional optimization techniques don't account for. And volatility roughness, why is it causal? It's caused by ultimately by microstructure events, illiquidity, and regime shifts, right? So yeah, there are these motivations. Now, other motivations are from crashes. We know that, okay, subsimilarity means that statistical properties of markets are invariant under scaling time by lambda to the 1 over delta times time, and x, which is log price, by lambda times log price. Now, at times of crashes, it's observed that delta goes from its usual value of half to 1. And usually delta is between half and 1, and it's called the dynamical critical exponent. Now, note that this is not yet, I'm not called it the Hurst exponent or anything like that, and that there's a reason for that, which I'll come to. There's a whole Lie group picture that can motivate this as well, where you can start with each of these cases of delta as being characterized by a certain group theoretic interpretation, and that can essentially also motivate this. I'm not going to go too deep into this because not many people know about group theory, but what people do know more about is PDEs, and in particular fractional PDs. And um, most models of markets assume that you have some kind of PD dynamics governing it. The most generally, you can write these fractional type PDs, right, where you have a fractional derivative of the time, and then a fractional derivative of the time derivative and a fractional derivative of the spatial derivative. And so for beta equal 1 and alpha equal 2, you have exactly Brownian motion, okay, which is the usual Black-Scholes assumption. Here, now, if you want fat-tailed, like an alpha stable distribution, you keep beta at 1, but you allow alpha to vary between 1 and 2. Similarly, if you want time dependence, which is, somewhat of Hertz dynamics, but no fat tails, you allow beta to vary between 0 and 2, and you put alpha at 2. And then most generally, beta will not be 1 and alpha will not be 2, and you can play with both of them. But now you see that, this is, pretty much a reasonable model of markets. Like, I think it's the most general model of markets that accounts for fat tails and also time dependence, time dependent dynamics. And really, starting from this picture, you'll notice that our what we call the dynamical critical exponent is really beta over alpha. So, you know beta is basically the Hurst divided by 2, and is capturing the effect of time dependence. Alpha is capturing the effect of fat tails, but really beta and alpha are not directly measurable. I think this is a mistake that a lot of studies make, is that they think, oh, you're measuring Hurst. No. When you're measuring these scaling properties, you're measuring actually this delta, which is the combined effect of the Hurst and the fat tails. And that's why this will be kind of the hero of our story. And think of it as a more general kind of Hurst, this, dynamical critical exponent, delta. Before I go on, KRS, I'm 15 minutes in. Can you remind me how much time I have so as to, tailor this accordingly?
Okay, and let me see what the time is. 11:05. I have to go back and look at the schedule also. Hold on. No, not there. Okay, you have time up to 11:20.
Okay.
11:28.
11:25, 15 minutes getting over.
11:25. Okay.
Okay.
No.
So I'll do to wrap up in 15 and leave some time for questions. So now the how do you measure this, delta? I said it's measurable, but I didn't tell you how we measure it. For these fractal, self-similar processes, you can actually constrain the form of the expectation values. So one thing that happens when you assume this fractality or this self-similarity is that you get power laws for your expectation values. Okay. So let's say you take this 2-point expectation value, this 2-point autocorrelation between log price at time t, log price at time t plus tau. This goes as some constant divided by tau to the power 2 times delta. Okay. And now the challenge is to measure delta. Now you can see that the left-hand side is measurable, this 2-point function. So you can actually take the log of both sides and you can invert the relationship to get delta in terms of g of t and tau. Okay. And you can get this for different values of t, different values of tau. But now you have 3 options. If you want to assume stationarity but not self-similarity, you can average over time. If you want to assume self-similarity but not stationarity, you can average over tau. And if you want to assume both, you can average over t and tau. And that will be basically your usual critical exponent, because usually we assume the existence of both things. But in this case, we have a slightly more general framework where we can break one of the 2 symmetries. Okay. Similarly, we can even, we're allowed multifractality. And what does multifractality mean in this picture? It means that we have these generalized Hurst type exponents where you have, let's say, higher moments of the log price. They scale as absolute value of t to the power delta n. So for every moment n, you have a potentially different critical exponent delta n, which again can be inverted to be written in terms of the original one. And for, let's say, 2-point expectation values, you can get these, delta mn's, which tell you, which again, they're these higher order multifractal type critical exponents. And basically, you get multifractality or nonlinearity if delta n is not equal to n times delta, or if delta mn is not equal delta m plus delta n. And in finance, I'll show that you do have multifractality, and because neither of these equalities hold, and we can investigate the cause of that multifractality. But this is going to be very useful in portfolio optimization, right? Where you want to account for multifractality. Now, before going ahead, I want to note that this delta can also be imaginary. It doesn't need to be real. And the case of imaginary delta happens when you have bubbles, where you have the evolution of price before the crash. Let's say during a bubble is usually given by some power law with the real and an imaginary part. So it's like a complex critical exponent, and many people have motivated that as precursors to crashes. So just to summarize, like why do we need when do we need multi-scale optimization? We need it when these deltas, which could be Hursts or your alphas or your fatness of tail parameters, are extremely different from each other for different assets in your portfolio, right? For different stocks or uh, PE funds, VC funds, whatever is in your portfolio, real estate. Whenever these are very different from each other, you want to account for these in your optimization. Okay. And special cases we've seen are rough volatility, crashes and bubbles, regime shifts and shocks. And these are different from each other, and non-ellipticity. When asset returns exhibit varying fat tail distributions. And this is extremely common when you have illiquids, like corporate bonds, PEs, VCs, emerging market funds, or like emerging market assets in general, etc. And you'll see that here a lot of in all these cases, basically traditional Markowitz struggles. And yeah, our physics-based approach, which accounts for these scaling laws, does not. Now, what is traditional Markowitz? Like classical Markowitz, what you're doing is you're minimizing portfolio variance. Okay, so you're basically, the sigma ij is the covariance matrix, which is computed at a single time scale, usually daily, and the portfolio variance can be written as a contraction of wi wj sigma ij, and you're doing an optimization where you're finding minimum across the different weights. If you're worried about fat tails, you can minimize this L1 covariance as well. It's the results are really similar, but in reality, we have this sigma ij actually depends on it depends on scale. It depends on delta t, and it scales as delta t to the power delta ij. And now there's a problem with Markowitz because you could have assets with extremely different scaling properties. Let's say you have two uncorrelated assets. They have the same volatility, but they have very different tail risks, and they would get exactly the same allocation as per Markowitz. Clearly, this is wrong, and this needs to be fixed because the asset with more fat tails or more time dependence is clearly the more risky one, right? So solution is to minimize this multi-scale covariance, sigma ij ms, where you're averaging this over delta t. So at each delta t, you compute your sigma ij at that scale divided by delta t, so that is normalized, and then you take the average. Okay, there's other things you could have done. You could have taken like a maximum instead of like an average and so on, but that doesn't matter that much. I think ultimately you end up getting similar results. Now, how to do portfolio optimization using this? Well, one could think of kind of three ways to do it. One is doing some kind of vol targeting, where you target not only your volatility but also your Hurst and so on, and then you use it as a constraint, which is one way people do Markowitz. One is doing a minimum variance or maximum Sharpe portfolio by averaging your weights across scales. And the third is to use the multi-scale covariance estimate in your optimizer. And actually, the second and third approaches, they look different, but they give extremely similar results. The first one is obviously a very different kind of approach, but we don't look at it because there's that. I mean, it doesn't yield a unique solution. Essentially, you need targets. So I'm not going to look at it here. Here, what I'm going to focus is on the third approach when I'm presenting backtest results. Given that that's the most common way allocators would use Markowitz. I mean, the first approach is more for academics. So second and third are more used in practice. Before that, let me just motivate like what multifractality really means in the variance. Well, multifractality means that your delta Q is not equal Q times delta Q of one. So your or delta one, it should be delta one. So this just means that basically your variance, your dynamical critical exponent of the variance delta 2 is not equal to 2 times delta. It's very simple what multifractality means in variance, but it's much more interesting what multifractality means in covariance, because this basically means that your scaling exponent delta ij here is not equal delta I plus delta j. So and if you expand the formula for the covariance, right? You have the correlation, and then you have the products of the correlation and the two variances, and you see that really what this multifractality means, that your correlation itself, rho of delta t, scales non-trivially with time scale. So delta of rho ij is non-zero, and that's what it means by multifractality. But we already know that delta rho ij is not zero. And this is a well-known effect in finance called the Epps effect, which refers to the empirical observation that as your sampling frequency increases, the correlation between asset returns actually decreases. So you look at, let's say, minutely returns between Coke and Pepsi, you might have like 0.2 correlation. You look at 10-minute returns, it may be 0.3. Hourly returns, it may be 0.5. Daily returns, it may be 0.7, and so on. So your correlation kind of monotonically increases with scale. And yeah, in the way that you kind of see here, right? As you increase the time scale, your correlations also increase, and this is caused by these cross covariance effects. And so we already know that delta rho ij is non-zero, and it's around 0.3. So we already know that that there is multifractality in markets, and therefore we must we have a good motivation to do multi-scale averaging. And essentially, in a multifractal setting, portfolio optimization works just as before, except that you account for the scaling properties and before putting the constraints. And you can see special cases of this approach. You get what you expect. When you have elliptical portfolios or you have Gaussian portfolios, you get Markowitz. But in the self-similar case, where when you have non-ellipticity, you will get something different. How different? Well, maybe we want to, before actually running the back tests, we want to see how our weights change with different parameters, that they change in the way that we want. So we've done this calculation in the paper, so that, okay, the more the volatility of a stock, the lower the weight of the stock. That's what you expect. Similarly, the more the dynamical critical exponent of the stock, delta, the smaller the weight of the stock, right? So the dependence of the weight on the monofractal critical exponent is negative. Also, the dependence on the weights of two stocks on their multifractal critical exponent is also negative. It's also something that we show, right? And what does this mean? This means that we basically pass the smell test. If you increase the volatility of a stock, portfolio weight goes down. If you increase the Hurst or the fat tailedness of a stock, portfolio weight goes down. If you increase the correlation between two stocks, their combined weight goes down. And if you have positive multifractality in two stocks correlation, their combined weight goes down. Everything is as you would expect it to be. Everything is according to what you expect from risk management techniques. So having passed this smell test, let's go to the back test. We have 5 years of data spanning 2019 to 2024. We used sector ETFs for the 11 sectors of the S&P 500, basically having a long-only sector rotation strategy first. Then we considered a factor rotation strategy where we considered 9 pharma French factors: quality, growth, value, low vol, etc., where each factor was represented by ETFs. So we have a sector rotation and a factor rotation strategy. Look back was chosen to be 6 months, which is very common in these studies. 6 months is 125 trading days. And we constructed minimum variance portfolios with overlapping versus non-overlapping time averages. And we also used AI-based approaches and Markowitz just for comparison. And then we present performance results: Sharpe, Sortinos, max drawdowns, etc. So for the sector rotation, really, as you might have guessed, the best result is with multi-scale Markowitz, where you have actually equally weighted gives you Sharpes of 0.5, Sortinos of Sharpes of 0.45, Sortinos of 0.53. Traditional Markowitz actually gives you lower Sharpe and Sortino, but also lower drawdown than equally weighted. So your max drawdown is 33%. But think about AI-based approach, the off-the-shelf AI-based optimizer, which we used based on RNNs, gives you worse Sharpe, Sortino, and max drawdown than either Markowitz or equally weighted. And the best result is, the multi-scale Markowitz case. I mean, with and without overlapping is fairly similar. You can see that the step up is pretty significant, and the max drawdown goes down to around 31 or 30%. Almost always a multi-scale case has lower max drawdown, even if it has slightly lower Sharpe. The overlapping case has lower max drawdown than the non-overlapping case, even though the Sharpe may be slightly less. In this case, overlapping Markowitz has Sharpes of actually even higher and lower drawdowns than the non-overlapping Markowitz. But obviously, these are better than equally weighted and traditional Markowitz, and also these non-overfitted AI-based approaches, again, which give results in this case very similar to equally weighted, and slightly worse than traditional Markowitz. So we see that in both the cases, like traditional Markowitz actually outperforms like an off-the-shelf AI-based approach to portfolio optimization. But really, what performs best is this multi-scale physics-inspired approach. And that is the key result of this particular talk. I have 5 minutes now, Lena. Did you say I have 5 minutes for questions till 12:25?
Oh, 1 second.
Or maybe 3 minutes now, I
Yeah,
guess.
we can have 3 minutes.
3 minutes, okay. So all this is the talk for next time. There's other extensions, but yeah, I'm just going to end right here with the conclusion that we have an approach that gives a more general measure of scaling. It overcomes limitations of classical Markowitz, especially in rough vol, bubbles and crashes, and illiquid securities, and overcomes the limitations of AI-based portfolio optimization, which are overfitting, lack of transparency, and lack of inability to handle regime shifts. So with those conclusions, please ask any